In today's video, we're going to be talking about liquidity. Now, liquidity is the single most important technical analysis concept in this entire bootcamp. So you need to understand this exceptionally well, and if you don't continue the bootcamp. You need to understand liquidity, what it is, how it works, and how to identify it on a chart. So that's what we're going to be covering today. Now, before one can understand how to see liquidity on a chart, we have to start to understand what liquidity is. And put simply, all liquidity is just resting orders, okay? If there's sell orders above price or buy orders below price, that's liquidity. It's just unfilled resting orders in the marketplace. If you've ever placed a limit order onto the market, you have created liquidity in the market. And that's it. Clap it up. End of the video. No, there is more to it. It's a little bit more complicated than that. But just knowing that isn't really going to help you on a day-to-day trading basis. Now, what is going to end up helping you is understanding why it's useful to us as traders, why the understanding of liquidity is useful to us as traders. And for that, we need to take a quick pit stop to understand how orders are executed in the market. So let's say we have a market like so, like the one in front of us right now that I drew. Courteous of me. This is my art. And this is the current market price right here, okay? So let's say that I would like to buy $1 million of this market at the current price, right? I want to buy it at the current price. And ideally, I'm filled with everything at the current price. I want to buy $1 million of this market at the current price. Now, for that order to ever get filled, I will need somebody also at the current price to sell me $1 million of the market. If I would like to buy something, somebody has to be there to sell it to me. This is how the market works. Also, if I wanted to sell $1 million of this market at the current price, somebody would need to be there to buy it from me. Now, for an average trader, this is okay because you're not trading with tens of millions or hundreds of millions of dollars. Anywhere in the market, you could go in, you could press buy, you could press sell. You're going to get filled immediately and at the level that you wanted to be filled at. Because at every single price level in the market, there's a ton of liquidity, which, remember what I said, there's unfilled resting orders. So if I hit buy, there's probably an unfilled resting sell order right there, right away, in order to fill me for the amount that I wanted. And there's a lot of these. So at every single price level, there's probably hundreds, if not thousands, if not tens of thousands of dollars worth of liquidity, literally at all price levels at all time. So for the average person, you and me, we're not going to notice a delay when we press buy or sell, and we're not going to really notice any liquidity issues. But we're also not the people who move the market, right? Our little bits of money, our $100,000, our $500,000, our $1 million, our $10,000, our $5 are not moving the market at all in any meaningful way at all. The people that do move the market are the people who are having multi-million-dollar positions, tens of millions of dollars in a position, hundreds of millions of dollars in a position, billions of dollars in a position. When these people execute their trades, when they press buy or when they press sell, that's what drives the market up and down. How? So the way they do it is as follows. I've set up an example here on the screen. So this is the current market price in this situation. There's resting orders on every price level above us. Let's imagine there's $600,000 of orders on this level, as you can see here, all the way up to only $100,000 worth of orders sitting on this level up here. Okay, and for ease of explanation, let's call these all sell orders on the top and all buy orders below the market. So there's sell orders above the market, there's buy orders below the market. If somebody comes in and says, I want to buy $600,000 worth of the market right now, price will jump up to the first level of liquidity above that has enough orders to fill their order. And this is why price moves. So if somebody came into the market and bought 600K worth of price, in this example, price would immediately jump to this level. And that's all fun and games, but let's imagine that somebody wanted to buy more than 600K. Let's say that somebody came in that market price, they said, hey, I want to buy $2 million worth of this market. Well, what's going to happen to price? It's going to go up to the first level of liquidity, and it's going to fill $600,000 worth of their order. So now they still need $1.4 million worth of an order filled. So it's going to push up, and it's going to go to the next level of liquidity. And here it's going to fill $500,000 worth of their order. They still need $900,000 worth of their order to be filled. It's going to push up. It's going to fill $400,000 worth of their order. They still need 500K to be filled. And it's going to do this, and it's going to keep filling parts of their order until they get up here. And what happens in this situation is because their order got filled over and over again, what's going to happen to price is price will immediately move to this level, right? This is why we see price move. It'll immediately seek liquidity to fill that big order. But the person who initiated that buy to buy right here, well, now their average position is filled way up here, for example. Because every single time they get filled for a portion of the position higher and higher and higher, it's bringing the average cost of their position higher and higher and higher and higher. So the person that bought with all this money wanted to be filled right here. They wanted to get into the market right here. But because of a lack of liquidity, when you're operating on this level, when you're moving this much money, your position actually gets filled way higher in the market. And that's a problem. And this is where we could start to find an edge. And by the way, the same thing works on the bottom too. I'm not going to go through that long drawn out example again because it's a long and drawn out example. So if what I said is true about every time a very big participant in the market, the people who actually move the market want to enter, they use up liquidity in the market. And if it's also true that it's in their best interest to enter in the spot with the most liquidity so that they could get filled closest to where they actually want to get filled, then we could come to a conclusion that it would also make sense for them to drive price into locations with the most liquidity. So that begs the question, how do we know where there's a large amount of liquidity in the market? If I'm a big trader who's moving millions, tens of millions, hundreds of millions of dollars, and I want to buy the market, how do I know where the most amount of sellers in the market are to sell to me? And if I'm a big trader that's moving all this money and I want to sell the market, how do I know where the most buy orders are in the market? So the secret lies in stop losses. What do I mean by that? So if we look at this market right now and we want to analyze it in the idea of where are the orders at? If I asked you where's the most buy orders on this entire chart right now, where would you assume? Would you say there's the most buy orders underneath here? There's the most buy orders here or here or here? You would be completely wrong. The most buy orders are up here. Why are the most buy orders up here? The answer to that question, again, is stop losses. So we know as humans are predictable, okay? We often do the very same things over and over and over again. So that also goes into trading. Humans put their stop losses in the same place all the time, okay? Where do they put their stop losses? Humans put their stop losses above the prior high when they're shorting and below the prior low when they're longing. That's just what humans do. It's always been like this, and it will always be like this. So think about it like so. Anybody who shorted up here, anybody who shorted right here, anybody who shorted right here, for example, even, all their stop losses are going to be above this high, okay? So we could understand that there's a large collection of stop loss orders resting above this high. If the market continues and the market pushes like this and then falls down, anybody who shorted here are going to put stop losses above this high, okay? So generally, we could say that above these two highs, there's going to be a lot of stop loss orders. The next question that you should ask is what kind of orders are those stop loss orders? Well, if I'm shorting the market, if I'm selling the market right here and putting a stop loss here, these are buy stop orders to buy back my sell position at a loss. So we could reasonably look at this chart and say, hey, there is very likely a high concentration of buy orders right above this high in the form of stop losses. And there's also buy stop orders there from people wanting to buy a breakout, right? People who have buy stop orders just placed here that aren't stop losses that want to buy right when price goes above this high. So we have stop losses up there and we have stop orders up there to go long. So again, we could come to the conclusion there's a huge concentration of buy stop orders up here. And in the very same way, we could come to the conclusion that there's a huge concentration of sell stops down here. Why can we come to that conclusion? Again, we could come to that conclusion because anybody who bought in this wick, anybody who bought even up here, for example, anybody who's buying right now, their stop losses are going to be underneath this low most likely and underneath this low most likely. Okay, so because this low was the one that got respected, this is where the stop losses are going to accumulate. Because this high is the one that got respected, this is where the stop losses are going to accumulate. Hopefully you're starting to understand this. So great, getting back into the mindset of that ginormous trader. We move a ton of money in the markets. We now know where all the sell orders are, and we all know where the buy stop orders are too. So let's now put ourselves into the mindset of that trader. I'm a giant trader. I would like to buy a huge amount of this market. What am I going to do? Well, in order to get filled at the price that I would like to, I'm going to drive price underneath this low, and I'm going to buy from everybody's stop loss that is willing to sell to me here. From every sell stop order that's willing to sell to me here, I'm going to accumulate buy positions. So this range down here is where I'm going to be accumulating buy positions at, if I'm a trader that wants to long this market. And because I know this is where the majority of sell stops are, I know there's a high likelihood here, I could buy a ton of this market and get filled at a reasonable price. And now I'm long. I have a bunch of the market. I've bought it all. Now I need a place to sell to. Well, I just so happen to know where all the buy stops are. How do we know? There was just a break of structure. This low just broke. A lot of traders are going to look at this as, oh, it's market structure. It's going to create a lower high right here, and it's going to sell off, right? So people are going to short in this range when price comes up to it, putting their stop loss above here. People who are still short from up here has their stop loss above here. And me as a giant trader that's in a long right now, I need a bunch of buy orders to sell to so I could take profit. So it would be in my best interest to push price all the way above this high. Boom. And once it gets above that high, I can now sell my position. Okay? And this could work opposite way as well, right? Let's say that this trader wanted to sell first, then take profit at the lows. Well, it makes sense for him to run price into the buy stops before selling and then run it into the sell stops when taking profit. And this is the basics of liquidity. There's more to this video. But this is the basics of liquidity. The big players in the market are going to try to identify where the largest collections of liquidity are, where the most liquidity has accumulated. If the market is bullish, if the trader is bullish, they're going to be looking for the biggest collection of sell stops so that they could drive price into them and fill their big buy orders. If the market is bearish, if the trader is bearish, they're going to be looking for the biggest collection of buy stops to drive the market into and sell the market at that level. But this begs the question, how do I know that a liquidity grab, which is what we call these, or liquidity sweeps, when the market seeks liquidity and pierces a low or a high like this, how do I know that a liquidity sweep took enough liquidity for the market to be satisfied, right? Because we don't actually know how much liquidity is down here, right? There could have been $1 billion or $1 million worth of liquidity. We only have our best guess based off of prior human behavior. We know that there is stop losses below here. We don't know how many stop losses are below there. So how can we start to get an idea if the market is going to go deeper for more liquidity? How do we start to get an idea if this low is actually safe until we go run these highs? Well, it's very simple. It's the respecting of the low that you swept. So this green line was the swing low that we swept for liquidity. If the market comes back down into that swing low and does not go below it, this is usually a good sign that liquidity actually was taken and there was enough liquidity down here. Why? Because if the market is not willing to go back underneath this price now, why? Because the market doesn't need to go back underneath this price if liquidity was already taken, because the market only moves for liquidity. Remember that. So once you sweep a low, you could treat it as, once you sweep a low and get back above that low, this area is now off limits if that's a real liquidity sweep. You want to see the market staying above that low and holding above that low if it happens to trade back down to it. And once this happens, you could be somewhat convinced that the market's going to go up and try to take the opposite side of liquidity. But let's take another example here. The market pushes up, it falls back down, it comes down to this low, it gets underneath it, and it can't get back above it now. This should be a huge red flag, massive red flag, a red flag that the market needs to go and run more liquidity. Why? Because if liquidity was actually swept underneath this low in the first point, if enough liquidity was swept underneath that low, the market has no business being back underneath here. So if it can't get back above that low in this case, it's probably going to go make new lows. And it's going to keep doing that until it holds up and pushes. This is also where you get the famous inverse head and shoulders pattern. But this is why that pattern even works. Now, there's another way that this could showcase itself. So imagine we have a market that looks something like this. The market's coming back up towards the low that it just swept, right? It just ran these lows. You think it's liquidity sweep. It's all good. And the market comes up. Maybe it gets above for a second and immediately falls below. It's really struggling at this level. You see it ranging around this level. Every time it pops up, it falls right back down. It's having a really hard time to get above this level. Or even it goes up and it just hits it once and it just can't get above that level. Whatever it may be, this is a huge sign of weakness that the liquidity swept down here was not enough for the market to go higher. Because if it was, you'd get right back above this level and go. Because there's no reason for the market to be down here anymore, because the only reason the market does anything is to seek liquidity. So liquidity was already taken. It should be looking for liquidity on the top side now. So when you see this, it's a very highly likelihood sign that the market is going to go run the low again, and it's going to fall down again until it could get above and stay above one of the old lows that it swept. That's how you start to know that the market's switching sides and possibly going to go seek liquidity on the top now. Hopefully that makes sense. And now this is going to be the introduction of what we call trend-based liquidity. Trend-based liquidity gets created if a liquidity sweep fails. So what does trend-based liquidity look like? Well, it looks like this. The market sweeps a low, it pushes higher. It looks like this is going to be a liquidity sweep to go take the next high, but it stalls up here. It fails, and it falls down. And then it pushes higher, and it falls down again. Every single time it trades to one of these lows, it keeps falling lower and lower till eventually market gets above one of these lows. It holds, maybe it rejects that low. And now we have something called trend-based liquidity. So we know that every single time a high gets respected, stop losses, buy stops are placed above that high. Okay. This high gets respected here. Buy stops are placed above that high. This high is getting respected here. Buy stops are getting placed above this high. This high is getting respected here. Buy stops are getting placed above this high. And people are going to try to follow that trend. So people are going to be shorting right here, and buy stops are going to be based above this high. This is what creates traditional trend lines in the market. So when people draw trends like this is what's actually creating that. It's people selling over and over and over again. So we know there's a ton of liquidity above all of these highs. And oftentimes, this is what causes aggression in something like a trend break, when the market rapidly and aggressively runs higher all the way to the top of that trend just to mess around and come crumbling down. Because people know that a huge amount of liquidity is built up along the way, the most aggressive moves that you're often going to get in a market is when trendline liquidity gets seeked. Okay, and you could start to recognize that by the patterns that happen after every single low breaks. Is it expanding after low breaks, or is it accumulating on that low? Is it staying above that low? How is price reacting to that low? If it can't get back underneath it, that means the trend-based liquidity is likely to get taken. And if the trend-based liquidity is likely to get taken, this is how you find extremely explosive moves with just liquidity in the market. So now we've gone over what is liquidity, how to identify where the most sell stops are and buy stops, why that's useful, how to identify if a low is going to sweep again, how to identify the change from a single liquidity sweep to the generation of trend-based liquidity, why trend-based liquidity even pops like it does. We understand and we've described that all. Now, a lot of these examples were buy examples. It's the exact same thing with sells on the top. You have to understand this exceptionally. This is the foundation to directional bias. This is the foundation to my model, the 4-pillar setup. The understanding of liquidity is foundational to everything. Now, on the internet, you'll see a lot of people say, oh, just look for equal highs, look for equal lows. It's not that simple. It's even simpler, okay? Stop thinking in patterns. Stop thinking about equal highs and equal lows. Start thinking like somebody who has a ton of money in the market and needs to buy. Where are the orders? Liquidity is not a pattern. It's not an indicator. It's nothing. It is where the orders in the market are. If a high got respected by another high, there is buy stops above that high. If the high that respected the first high goes on to break market structure, break a low on the bottom, and then it comes back up, there's even more buy stops above that high. Why? Because it's tricking traders to go short and place a stop loss above the high. If a low respects another low, there's liquidity under there. If the low that respected the first low goes on to break a high, there's more liquidity under there because you've now tricked traders into believing a market structure shift has happened, and to go short with with sell stops, and to go long with sell stops underneath the low. So look out for all this. If you want homework, go identify on your charts, go in replay mode, go back in history and look at uptrends in the market and watch how liquidity on the bottom is always taken in uptrends. Go to downtrends in the market in history and watch how there's points where liquidity is taken on top. Go and look for examples of trend-based liquidity and how those produce extremely quick moves in the market, and you'll start to see all of this. But now you have a very deep and good understanding of liquidity. As a final word, I'll leave you with is the majority of liquidity sweeps for sell stops happen in upward trending markets. The majority of the sweeps for buy stops happen in downward trending markets. If a market is moving higher, you're just going to blast past highs because nobody of interest, nobody with a lot of money wants to sell that market. Nobody wants to sell that market. People just want to buy that market. But what's going to happen in an uptrend is every swing low and every equal low, everything, if it gets taken, it's going to be bought up and the price is going to shot up. In a downtrend, every single high is going to be sold immediately. And every single low, it's going to get expanded through. And usually that expansion is creating trend-based liquidity. So it all kind of goes together. Understand where the liquidity is and you understand where the market's going. Join the Discord down in the description. This is Bootcamp Day 2 and we're going for 40 episodes.